Thank you, Guntram, for a very interesting talk. You covered very important aspects of the problems which the European economy faces, basically looking at some analogies with Japan about the fear of continued stagnation here. Probably you can tell us a little bit about what are the analogies with the Japanese situation and also the differences between Europe and Japan in terms of what it faces over the coming, let's say, 5 or 10 years.
Yes, so what we are doing in this paper is we really try to comparatively look at Japan and the Euro area and also the United States. And I think we see a couple of similarities between Japan and the Euro area that are not really visible when you compare those two economic areas with the US. Both Japan and the Euro area have had quite low growth after the beginning of the crisis. In Japan in the 1990s, in the Euro area in 2007, growth was really, really bad. And you see that growth in the Euro area is underperforming growth of the United States. So quite a substantial difference in terms of GDP numbers. You also see that by now inflation rates have come down very substantially in the Euro area, and the deflation scenario is a serious risk with which we have to deal. And of course, Japan has been going through a long period of deflation. So I think the macroeconomics looks quite comparable. Now, then you can ask yourself, well, in the banking system, how many differences do we see, or how much does it look similar? And the reality is that in Japan, it took basically 7 years until the Japanese government really started to tackle the banking problems. For 7 years, losses were not recognized and the banks were just sitting on their bad loan, evergreening, giving credit to old corporations instead of really extending lending to new business. In the Eurozone, we still have to see how our banking saga ends, but certainly we've been much slower than the United States in tackling the banking system problems. And of course, the ECB is now, as a new supervisor, responsible for tackling these banking problems and addressing this. But we will see how strongly the ECB will intervene, and certainly this combination between a weak macroeconomic outlook, low inflation, low growth, is not good for the banking system and could mean that new banking system problems actually emerge.
Isn't one of the central problem in Europe, in comparison to Japan might have made policy mistakes, but the so-called economic policy mistakes in Europe really come out of a political structure, which in one sense one can just say the fear of risk pooling, and that prevents, in a sense, the use of the tools of bank restructuring, which might be, but also the fiscal policy side. So in the end, it's all goes back to the political problems of pushing the polity of Europe in the direction of being prepared towards more risk pooling.
No, I think I agree. I mean, the governance of how to deal with crisis is very different in the two countries. I think if you look at Japan, you certainly know that Japan has had very substantial governance problems also in the banking system, where the supervisory structures were weak, where also the shareholders of banks were often not really interested in restructuring banks, in making sure that the management actually deals with the problems proactively, because there were cross ownerships and so on. So I think Japan had quite a bit of governance problems that prevented an effective dealing with the banking system. But of course, it's true that Japan as a country is a homogeneous country with one policy system, with one prime minister, with one central bank, with one treasury that can actually deal with these problems. And of course, what we're seeing now is with Abenomics, we're seeing a massive change in the policy stance, and it's actually feasible to do that just because there has been one election to do so. Now, in the Eurozone, we have a system that is extremely complicated, and I think at the core of the problem that we are having in the Eurozone is the fact that we have one central bank but 18 national treasuries, and those 18 national treasuries basically follow national election cycles, national logics, and make the resolution, and that makes the resolution of our problems much more difficult, because you have to essentially coordinate among those 18 treasuries, and that's very difficult.
When I listen to you and also look at some of your writings, you always emphasize there are three major areas which prevent the resumption of growth and solving Europe's problem. One is the very delayed bank restructuring process, which keeps us in a situation of very, very weak banks. The second one is a problem of fiscal coordination, and therefore Europe in a sense has a bias towards austerity. And the third one is how to deal with structural imbalances. And I think the way you present it is that while monetary policy has been working reasonably well since the beginning of the crisis, the other areas have not been working well, but all three problems have to be solved. Now, how do you see, looking forward into the future, the path towards a resolution of these problems? A simple question.
A very simple question, absolutely. Look, I think the on the fiscal side, the way out, to my mind, will have to be eventually the creation of a small Eurozone treasury, which means at the end of the day, it means some form of revenue tax raising power at the Eurozone level. And I don't think that needs to be very big. I actually think 1% of GDP in terms of tax raising power, in addition to what we have now. So 1% of tax raising power would probably be enough, but of course that's a big change, because it means you have to have the parliamentary control mechanisms at the Eurozone level.
But one also has to decide how to use this 1%.
Absolutely.
So that would be a stabilization function,
yes,
which the Commission doesn't have so far, no?
Yeah, I think I would use it for stabilizing area-wide shocks, and I would use it as a backstop for the banking system, basically. I mean, that's the two main functions for which you need fiscal policy, I think, at the federal level. Now, how to get there is difficult, but I think it cannot be done without a treaty change. So that's very substantial reform. Now, the other point is the internal imbalances, where essentially we have these very big divergences in prices and in current accounts prior to the crisis, and basically the current account divergence has come down on the deficit side, so deficits have really decreased very substantially, but surpluses have stayed very high, and prices haven't really adjusted. And I think this is a much more difficult thing to actually deal with, because what we are talking about is basically changes in wage dynamics, changes in price dynamics, and a period of, I think, 5 to 10 years at least of adjustment, where we will have to see wages and prices in Germany, in the Netherlands, also in Austria, grow faster than in the periphery countries. And so that is a very difficult process to engineer. I think we cannot afford to engineer it just based on very deep recessions in the periphery, because
which is the current mechanism by which it probably partly takes place. Yeah.
Which is the current mechanism, exactly. And I think that that is a logical mechanism. If you talk about a small country like Greece or Ireland, it has to be asymmetric, because Ireland is a small country, and you can't expect Germany to move because of Ireland. But when we talk about France and Italy, we will have to coordinate between Germany, France and Italy, because those two big countries cannot afford having those two big countries in a major recession for 5 years just for them to regain competitiveness towards Germany. I think Germany needs to grow more. Germany has to generate more demand, but it also needs to grow more, and I think that will be very beneficial for Germany, actually. I think German citizens will be much better off, paradoxically. So citizens will be better off. Of course, people pensioners probably will also be better off, but people that hold a lot of cash on their bank account, they may lose a bit because their purchasing power will go down. But overall, I think Germany will be better off, and citizens in Germany will be better off by such a policy, and it will make this adjustment much more easy.
Now, these policy shifts means overcoming the tremendous fear of moral hazard, no? Which exists in basically the stronger countries of Europe. And it seems to me as if this moral hazard fear is deepening. So, but it is a necessity to overcome it in order to move into the type of reforms which you suggest. Is that right?
Well, I'm not sure you have to overcome the fear. I think you have to overcome the problem.
The problem, okay.
So I would argue that we need to ensure, of course, that this doesn't turn into a transfer union where the strong countries systematically subsidize the weak countries. That is not acceptable.
So how would you overcome that?
So I really think it has to be a gradual process where you have a quid pro quo. I think the basic logic that has been advanced also by the German Chancellery actually quite a bit, I think makes sense. I mean, you have to see significant reforms, you have to see significant changes in the labor market, significant improvements in the government and the administration and so on in the countries that are weak. And only if you see those improvements, only then you can, adjust on the other side. So I really think the two sides have to move, and it has to be simultaneously. I mean, conversely, of course, the moral hazard is the one side, but of course, there's the converse fear now in the periphery countries, and also in Italy and France. You talk with policymakers there, they would tell you, well, look, if I'm doing the reforms, who guarantees me that Germany will actually change its own policy stance? So there's a big fear that that one side may act, but the other will not.
It's an asymmetric adjustment,
exactly.
Compliance process. Yeah.
So the two sides have to coordinate, and at the end of the day, you have to have more trust among the countries. I think at the end of the day, it's about this. You have to have trust in order to get all the countries move.
Let me ask you a final question, because I've seen that you also work on these issues, which has to do with the role of industry. I think I saw a paper which you did jointly with some people from CEPI, and what you point out basically, it's linked to the macroeconomic issue of external disequilibria inside the EU or the Eurozone. And we've seen prior to the crisis very strong divergence in the development of the tradable sectors. Germany and some other northern countries developing a very strong tradable sector, and the southern countries neglecting it, and it was shrinking. Now, do you think this underlying structural issue of readjusting sectorally also, or between tradable and non-tradables, can one simply rely on the macroeconomic adjustment processes of real exchange rates, the type of things you pointed out, wage, price adjustments relative to each other, or do you need other tools or complementary, additional tools?
That's a very good question. I mean, I think the let's say the old-fashioned notion that we do kind of Colbertism, kind of industrial policy to get back industry, which is very much the spirit of what the European Commission, the outgoing European Commission, has actually said about industry needs to be 20% of GDP and so on. I think it's the wrong approach. I don't think that will work. Industry strives because the conditions are right, and not because policymakers say it should strive. I mean, so you have to think about the underlying conditions for industry to be successful. And I think that's a lot about really getting the framework conditions right. I mean, I kind of have a very kind of market-driven view there. I think you have to have the right tax system, you have to have the right unit labor cost, you have to have the right education system, you have to have the right conditions for doing business. I mean, all these very traditional indicators, I mean, they are very important for people to decide, yes, I want to have a business here, or no, I don't want to have a business. So I think this really you have to get the framework conditions right. Then what you have to, of course, think about is quite a bit the education system and the innovation system. Yeah, I mean, the two are quite important. If your education system trains completely in the wrong direction, you will not get industry. That's quite clear. So,
but the notion that we have to get framework conditions right, that existed for quite a long time in the European Union. By the way, including the framework conditions at that time was also financial market liberalization.
Right.
But some of these framework conditions really led to these imbalances, no, between tradable and non-tradable sector. So have we got the right framework conditions, or the idea of framework conditions right now?
Well, okay, that's a good one. I mean, I agree with you that, for example, financial system developments were not going well, and there was too much deregulation, and certainly not enough, responsibility for the own mistakes in the banking system. So I think these are the things we have to work on. I think financial system stability and the stability of the banking system are absolutely crucial. So I fully agree with that. Now, I think there's much less evidence that the decline in industry would be due to would be due to mistakes in the framework conditions. I think it's rather due to the fact that we have not had the right basic conditions right for business. So my tendency would be to say, on the financial system, yes, we have to really deal with the problems. On the classical industry, I mean, no, we shouldn't start subsidizing certain industries and just to get these industries back. I don't think that will be suitable. We have to think about the market actually choosing the right winners. Certainly, I would be dead against creating, let's say, major subsidies now for coal and steel industry. I mean, why would we want to do this? I think we have to get the conditions, and the market then has to choose. Does it want to have Facebook, or does it want to have chemical industry, or does it want to have coal and steel?
But of course, the Commission in their current ideas of industrial policy, they don't want to go back to Colbertism, no? At least they don't say so. They are thinking of a new industrial policy.
Yeah,
but you think this is just rhetoric? There's not much new behind that.
I don't know. I mean, let's see with the new Commission. But you have to be very cautious. I mean, very careful that you don't fall back into the old trap. Oh, we need steel industry now, which was incidentally in the document of the old Commission, in the communication. They did explicitly mention steel industry.
I thought they mainly talked about technologies. No?
Yeah, but they still mention steel.
So
okay. It's like, why steel? I mean, I don't know.
Of course,
I think we should not take a sectoral view here. We should take a view about what is good for new activity, new business. But okay, that's a big debate.
So thank you very much, Guntram, for your thoughts.